Welcome to The Sound of Economics, the podcast series by Bruegel, the Brussels-based economic think tank. I'm Giuseppe Porcaro, and today we will speak about the failure of the Silicon Valley Bank and its consequences on the global markets. And I'm very happy to discuss this with Rebecca Christie here in the studio in Brussels, and with Nicolas Véron, who is joining us from Washington, D.C. Hi, Rebecca. Hi, Nicolas.
Hi, Giuseppe.
Hello, Giuseppe. Thanks for having me on.
Great. I will go straight to the point because the issue has been very much all over the news in the past few days, and we would like to have a little conversation with both of you to understand better, first of all, what has been going on, and especially to explain to our listeners some of the key questions that the failure of Silicon Valley Bank has been rising. So, first of all, I would say the events in the US, what actually happened. I would like to ask you to explain to us, and what is likely to happen next. And we will then go more about the consequences for us in the European Union and beyond in the rest of the world. But I would like to start really to ask. I don't know if Nicola or Rebecca wants to start to actually state the facts. What has been going on?
What we saw was a classic bank run. The difference this time around was it happened at a bank that was beloved by startups and venture capital in Silicon Valley. So we had a mid-sized bank that in and of itself, a failure wouldn't seem to threaten the entire financial system. But because of who was banking there and how they held their money, when the regulators came in on Friday to shut it down, people were very concerned about contagion and spillover. This was largely because the bank held so many deposits, business deposits. And there was a lot of worry that because business deposits generally are not insured, they have much, much more than the amount of money covered by FDIC insurance in the U.S., that this would somehow lead to an inability of tech companies to make their payroll, to pay their bills, to do other things like that. And this created a fear that there could somehow be a new type of contagion different from what we saw in previous financial crises. So that's how we went into the weekend.
Nicola, do you want to add something about that?
Yeah, I mean, what Rebecca says is right, but I still don't see how that squares with what we know in terms of the response. So basically, the question is whether the normal instruments to deal with these issues, shut the bank down, reimburse depositors who are insured, and sell assets. And actually, the assets of Silicon Valley Bank were pretty liquid, so the FDIC could sell a bunch of assets quite quickly, starting to reimburse the uninsured deposits. Why? So on Friday, the U.S. authorities signaled that they were applying that playbook, and to me, that sounded pretty convincing. And indeed, during the weekend, we had, a little bit more analysis of the balance sheet of Silicon Valley Bank, and it looked like the FDIC, the Federal Deposit Insurance Corporation, which is the resolution authority in the U.S., would be able to reimburse probably over half of the uninsured deposits during the coming week, and that should be able to do the payroll, enough to do the payroll and so on and so forth. So that looked to me like a very reasonable and proportionate course of action. And then during the weekend, something else happened, which was probably not a decision by the Federal Deposit Insurance Corporation alone. And we had that announcement of massive bailout last night with, unlimited guarantee of all deposits, essentially of all banks. It was announced, of course, for the two banks that failed, but that means that any other bank that is failing at this point will receive the same treatment, which is a measure that's not unprecedented. We had it in, September 2008 at the peak of the great financial crisis after Lehman Brothers failed. But that was in an environment where the financial system was perceived as much more fragile. So basically, one of two things must be right. Either the financial system is much more fragile than people like me had understood even after the announcement of the Silicon Valley Bank failure, or the package measures that were announced last night are overkill. They're excessive. They're not justified by considerations of financial stability. Maybe there are political considerations. We can discuss that. But I think at this point, certainly people like me are questioning whether we have seen the case for this massive intervention with all the moral hazard questions it raises.
Just on that, so Rebecca, do you think that the U.S. authorities failed to properly regulate and supervise that specific bank, or, I mean, the question that just Nicolas has been putting on the table? I mean, how do we justify what has been going on with the fact that we've been regulating the market after the financial crisis, exactly in order to avoid these kind of things?
These are absolutely the right questions to be asking. When you look at what happened, Silicon Valley Bank failed. It did look like it was going to be a sort of normal bank failure at first. And then another bank failed over the weekend, Signature Bank. And at that point, there was a concern that there would be more and more bank runs and that there could be a deposit confidence crisis. Now, would it be to the extent that you really need an unlimited guarantee of all deposits in the U.S. banking system? Probably not. On the other hand, as a way to shut all that down, for the feds to step up and say, look, for right now, uninsured deposits, we're going to make them whole, we're going to move on. It has some precedent. It is something that has been done in other moments of contagion. I would argue, and I'm not going to talk about regulation yet, I'm going to talk strictly about crisis management. Nicolas has made the point here and elsewhere that the messaging from the feds was bad and was inconsistent from the U.S. government, and I would agree with that. I would say, however, that they have been trying to learn the lessons of previous crises where they thought they were doing the right thing and things went out of control. Now, Lehman Brothers was an investment bank. It was not an insured deposit bank. At the time when they couldn't find a buyer for it, they thought, you know what? It's the market. Let it fail. They did not see coming the cascade of contagion that happened. They also were trying to sell it whole. What they've done with Silicon Valley Bank is, first of all, they've frozen it in the markets effectively where it is with the deposits to prevent any contagion going up. They're cutting it up and getting rid of the overseas subsidiaries. Is this going to turn out to pass what they call the least cost test? Is this going to be the way to save the most money for taxpayers? Probably not. Is it going to be a way to start getting the bank cleared off the federal balance sheets relatively quickly in a relatively safe way? Possibly. And the other thing I want to say about these two banks that failed is they're both weird banks. They're not banks that were making bad loans like we've seen in the past. They're not banks that were overextended on mortgages like we've seen in the past. Silicon Valley Bank had all of these deposits and made a bad bet on treasuries, sort of like we've seen with hedge funds in the past, rather than a traditional borrowing and lending operation. The other bank, Signature, was in crypto. These are banks that are sort of outliers in where they are in the financial system. And to me, the U.S. government decided that in the past, these innovative areas, like the part of AIB that failed, for example, these are areas where they can have real unexpected contagion, unexpected spillovers. And they just said, you know what, we're not doing that this time. We're going to freeze it all. Doesn't necessarily set a precedent later on. If another bank like IndyMac goes under and they see the deposits as more investments as opposed to people's savings and operating cash, they can make a different decision.
Nicolas, do you agree with this version of the story about how they are been managing the crisis so far?
So there's one thing that Rebecca said on which I agree completely, and that, you know, there are two separate discussions here. One is about the supervisory failures. And clearly there was a supervisory and also a regulatory failure in the case of Silicon Valley Bank. And we can look at that, but that's basically water under the bridge. So where it connects with crisis management is that it makes the Fed look bad. So there will be a suspicion that the Fed is trying to cover up for its past mistakes, inevitably. That always happens when there is a supervisory failure, and I think it's pretty obvious that there has been a supervisory failure with Silicon Valley Bank, probably also with Signature Bank. The other thing is the crisis management and resolution. And these two discussions should be, to the extent possible, be kept separate because, you know, supervisory failures happen. They should be avoided, but they happen. But that shouldn't inform the crisis management and resolution. So I think Rebecca is right to really distinguish between those two. Now, on the crisis management and the measures that were announced yesterday, I cannot help but be impressed by the gap between not just our respective perceptions, between Rebecca, who is an American in Brussels, and me, a Frenchman and European in Washington, but between Americans and Europeans more generally. So basically, a lot of American commentators, including among my colleagues at the Peterson Institute, have been like, okay, Tim Geithner is right. When you see a lot of risk, you have to go big and, whatever the metaphor, the bazookas, extinguisher, whatever, but you act fast and strong.
Whatever it takes kind of logic.
Well,
it's interesting you say that, Giuseppe.
Sorry, Rebecca, the European reaction to that crisis has been like, okay, we agree with that, and we think that, the US did that after Lehman and that was fine. Just that has only to be done when things are really bad on a systemic level. And we don't see things being really bad on a systemic level in the US because we thought, and we have been saying for a number of years, that, banks are properly capitalized, which clearly wasn't the case in 2008. So where exactly is the difference? It's in the assessment of the soundness of the financial system more generally. And here I want to pick up on some things that Rebecca said. Those two banks, SVB and Signature, were weird banks. If the problem is just a couple of weird banks, then why do measures that are of systemic nature and that completely change the perception of moral hazard and public guarantees, implicit and now explicit, in the US financial system? If they're only weird banks, you have to act on those banks and not on the rest of the system. But that's not what the US authorities did yesterday. So I'm still puzzled.
I see it differently. On Lehman Brothers, it's interesting you mentioned that from the U.S. and from the European perspectives, because from the U.S. perspective, the first reaction was, let it fail. There are Europeans to this day who say that American decision was the wrong decision and that America should have bailed out Lehman Brothers earlier, as it sort of did with Bear Stearns and as it was sort of forced into sweetening later on. And this cascade of bailouts, there are people in Europe who continue to criticize the U.S. for waiting too long to go in. That said, when the U.S. finally did go in, they did go in with Paulson and Geithner, go big or go home. And it took Europe a long, long, long time to get to whatever it takes. And even then, it wasn't on the same scale. So there's more overlap in the views than just the sound bites would say.
And I see Nicola that wants to react immediately to what you're just saying.
Yeah, I don't want this to be an academic discussion of the 2008 financial crisis because this one is different. But I will just say that in general, when it comes to banking, the US has been much more rigorous and more kind of attention to moral hazard than Europe during that great financial crisis. If you look at using that simplistic vocabulary that is really often unhelpful to capture the nuances, and the nuances are important. But basically, the long story short, from 2007 to 2009, at the peak of that financial crisis, Europe bailed out all its banks, and the US didn't bail out all its banks. But that's where the perception right now, there's a read across, because we Europeans, and again, I'm not going through the TikTok step-by-step sequence of 2008, because I think that's not what we're discussing now. But we Europeans felt the US had a much better system for bank crisis management and resolution, and that's a system administered by the FDIC, and it basically never bails out any creditors, others than depositors or shareholders. All these people lose money to the extent that the bank has a lot of money. The only thing it protects is the deposits, which is a much narrower perimeter of protections than the equivalent EU practice. And then it does a pretty good job at protecting deposits, but there is a very fine-tuned balance between insured and uninsured deposits. And from time to time, they don't reimburse uninsured deposits, and that's critically important to keep the discipline. And people like me felt the system is really good. We should emulate it in Europe. And in a way, that's what Europe has been trying to do with the BRD. And then we had adjustment because we discovered the BRD, Bank Recovery and Resolution Directive of 2014, doesn't work as intended. And actually, the European Commission this month, in March 2023, was expected to present a big reform of crisis management and deposit insurance, which was basically saying, the US still has a better system because they have this fine balance between protecting deposits but not creating moral hazard. And let's move closer to that system, which was very much the mindset. So seeing this system basically implode, which I think is what we saw yesterday, puts me in a state of shock. And probably that's what is making me very confused today.
I'm really interested that you are lumping bailing out all senior creditors with protecting uninsured deposits.
No, I didn't do that.
No, but it's not a full-scale bailout if all you're doing is protecting the deposits. It does create some moral hazard, and that, I think, boils down to whether you believe that the feds are willing to bail in uninsured depositors on another day in another bank. And I think they are. I think that they did this because of the effects on the Silicon Valley ecosystem, the effects on the labor market, the effect on venture capital, which is part of the financial system now, whether we want it to be part of banking or not. With the emphasis on shadow banking, the Fed has to be thinking about that. And I think they also learned from the EU's experience with Cyprus. Cyprus had also some really weird banks that had a lot of deposits and very few other senior creditors or junior creditors or other people they could bail in. The Cypriots didn't want to hit their uninsured depositors, so they decided to hit all their depositors, including their insured depositors. And boy, did that kill confidence in the entire euro area. They got a second try on Cyprus. But it showed that when you're dealing with deposits specifically and depositor preference, which is another slippery thing, regulators have to look at the confidence end of that as well as just the straight up, where do you fall in the waterfall of creditor hierarchy?
This is the core of the debate. So I need to respond to that. Indeed, Rebecca is entirely right. It's about depositor protection. This is where the debate is. Cyprus was bad. The EU and the IMF, by the way, took the wrong decisions there, and then had to correct course, and that was painful. And the lesson there was that it's a very bad idea to question the deposit guarantee, and it was a major mistake to do that in Cyprus. And even for uninsured deposits, you should try to protect them more probably than the EU tried to do in Cyprus. So we had those debates at the time. I concur with Rebecca's analysis of that. But when she says venture capital is part of the financial system, so it should be protected by the government, which is what I heard.
I wouldn't go that far, but it should be considered.
That's what you implied. Here I have to react. And full disclosure, my brother is a venture capital investor. I have most of my savings in venture capital. So my personal interest is to say, let's bail them out. And this is real, by the way, because it's also about investment in the US. So that's where my interests lie. I'm transparent about that. Having said that, venture capital is about risk-taking. It's about the most extreme risk-taking. It's about the most judgment-based risk-taking where you're willing to lose all the money because you also are willing to chase very high returns. And if there is a part of the financial system that shouldn't be insured by the government, that's venture capital. And that's exactly what we're seeing. What we're seeing is that Silicon Valley is too important to fail. And indeed, given the technical characteristics of this story, bailing out uninsured or reimbursing, if you prefer the word, making whole the uninsured deposits of Silicon Valley, which are not small people. They're big people. They're very wealthy billionaires. They're very big startups that got lot of cash, also small startups, but they're cash rich entities. This is a bailout of Silicon Valley. It says Silicon Valley is too important to fail. Is that capitalism? I'm not sure.
The thing about venture capital is that no one is talking about bailing out the other end of the venture capital, which is where the risk is supposed to be. The risk in venture capital is not the risk of putting the money in the bank. The risk is supposed to be all of the, interesting startups and things like that you're putting out.
I'm not convinced by this view.
I want to add something on this, and maybe another element which will bring us on the global perspective as well. When you say probably the U.S. government has been evaluating that Silicon Valley is too big to fail, maybe it's not just the too big to fail kind of logic of the past, but there is a geopolitical consideration as well over there. We are in 2023, we are not in 2008, and we've been seeing that overall competition at the geopolitical level between China and the US, semiconductors, high tech, artificial intelligence, and so on. This is core to the new moon race of the 2020s. So I suspect that there was not only a consideration about the financial system, but there was also a consideration about the geopolitical implications of something going bad in Silicon Valley. Is that correct?
Well, I can see how they wouldn't want to have a fire sale on whatever liquid business units the venture capitalists could find to sell off if they couldn't get their hands on their cash. There are a lot of reasons why the U.S. wouldn't want that, only some of which are related to finances. We should talk about supervision while we're here. My other gig is I write a column for Reuters Breaking Views about EU policy and global macro conditions. And over there, we've been talking about the Basel rules. My colleague at Breaking Views, Liam Proud, has written that the liquidity coverage ratio, which is basically how much liquidity do you have to have on hand to cover your deposits, was too low, was watered down, and that this is something that regulators really need to rethink when they try to prevent this the next time. I would add to that regulators need to rethink the balance between solvency and liquidity. Once again, this is an area where Europe has had a lot of debate, has not figured out what it wants to do, and they need to make sure that along with the central bank credit lines and along with the government support when something acute happens, that they look at making these places well-run and more solvent in the long term.
Yeah, I'd like to go back. I basically agree with Rebecca on regulation, but I think your question, Giuseppe, was not about that. So let's go back to this issue.
If you can get back to my issue about the geopolitical side of this.
Exactly. I would like to say this is not the case, because I would like to say the US authorities do banking policy measures for banking purposes, and then do Silicon Valley industrial policy measures for Silicon Valley industrial policy geopolitical purposes. But at this point, I think it's difficult to rule out the possibilities that you might be up to something, and that this kind of strategic considerations may have played a role in the decision of the US authorities yesterday. I'm not saying this is the case, because that would be a big statement to make. And I think, we need more debate, more evidence, more discussion before getting there. But it pains me to say that this is one of the most plausible explanations I see at this point to explain the massive package of yesterday, which to me, from a financial stability perspective, looks very much like overkill. So it's not the only possible explanation. I can think of others, but it is something that deserves a lot of debate, because we're talking about things that ultimately affect people. Beyond the fact that, of course, it's a myth that taxpayers and ordinary people won't pay for this bailout, because that means, there's a special assessment of the FDIC, and so the banks will have to pay for the bailout, and they will pass the cost on to the real economy one way or another, because that's the way it works. There are elasticities there, to speak the jargon. But beyond that immediate cost of the bailout, I think there is this issue of who is the government willing and able to protect. And at this point, ostensibly, they're protecting, the smart people, super educated, who make a lot of money in Silicon Valley. And I think this raises questions which have to be answered.
But since we cannot answer this question, and we are not running out of time yet, but soon going to run out of time, we need to touch at least a little bit about the effect that this is having in the European markets. We've been seeing on Monday stock exchanges going down, Milan particularly, but also others. And I would like to have a little bit of a contextual explanation about what's going on in Europe now.
This is where confidence comes in. This is where spillovers come in. This is where, to me, having the regulators and the crisis managers pay attention to little bits of the financial system they didn't think were that important, but echoing around the world, this is where those really come in. Before we had subprime mortgages, this was something where we thought, wow, the people who were buying and selling subprime mortgages, they're speculators. They don't need to be bailed out. But it turned out they were tied into everything. So now we've got Silicon Valley, which at least is easier to get your head around than mortgaged and securitized subprime lending. And I really see what's happening today in the markets as a confidence effect and rather than a fundamental economic effect.
And Nicolas?
The collapse of Silicon Valley Bank is bad news. It shouldn't have happened. It's a supervisory failure, and it's a negative shock for the market. So no question about this. So the stock market goes down. That's a feature, not a bug. Does that justify explicit unlimited guarantee of full deposits in the U.S. banking system? This is where Rebecca and I have a difference. But the fact that the stock market would go down is not surprising. I wouldn't call it a major crisis at this point because we've seen other events that make stock markets react. I think the bigger question for Europe is, can the kind of stuff we've seen in a number of pretty large US banks like Silicon Valley Banks, which was among the top 20 in the US, can that kind of thing happen in Europe? I don't have an answer to that because I've been surprised about Silicon Valley Bank, and that makes me humble. I will say, however, that we've heard for a number of years European supervisors, I think more than US supervisors, but I may be wrong about that, and Rebecca will correct me, say they are very vigilant about what the jargon calls interest rate risk in the banking book, which is exactly what has been at stake in Silicon Valley Bank. So my hope, I'm hesitant to call it an expectation, but my hope is that we won't see the kind of blatant risk mismanagement that we've seen at Silicon Valley Bank in European banks. But again, it's a hope, not a forecast, because at this point, I'm very humble about forecasting anything.
Absolutely. That is the nature of the unexpected. My sense is that at the bigger banks, this risk is being regulated and monitored. And if you look at the U.S. markets, the banks that are being hit hardest are the mid-tier banks, even though they are very different in their business models from each other and from the banks that failed, because that's where the markets are saying, maybe these guys are big enough to cause a problem, but small enough to fall through the cracks. In Europe, the issue probably isn't the size of the banks. In Europe, the issue might be the fragmented markets, the lack of unified deposit insurance, the difference in standards among countries. Hopefully, the banking union, in as much as it is half completed, will work to prevent that, and the new regulations will prevent that, but we don't know.
And I think that we have to absolutely observe how the next days are going to unfold on that issues. But I would like to say that nevertheless, even if when you're listening this episode, some of the stuff that we've been saying might be surpassed by events, all the discussion that we've been having on the more general and broad systemic level about what this episode of the Silicon Valley Bank teaches us or makes us think about, and the very relevant questions and I would say not disagreements, but different points of views between Rebecca and Nicolas that we heard, were, I think, very much stimulating food for thought for all of us. So I would like to thank you guys to join this episode of The Sound of Economics. And this is all the time we have, unfortunately. So thank you so much. And as usual, you can read in open access all the analysis by our scholars on our website, www.bruegel.org. Thanks a lot for following us. Until next time, bye-bye.
Thanks.
All right.
Thanks, Giuseppe, once again.